guys, welcome back. Now in this session, we are going to learn about capital asset pricing model, which is the famous CAP, developed by Sharpe, for which he won a Nobel Prize. Now we know that capital market theory is a direct development from the modern portfolio theory. It introduced the presence of a risk-free asset, which allows the efficient frontier to bend out to become the capital market line. We also say that we allow unlimited borrowing and lending at risk-free rate. So that's how we can combine risk-free asset with various rate in combination with market portfolio. Now, we say that if a certain investment choice deserves returns on capital market line, that is because they carry on market risk, with the market turbulence being the only source of risk on that line. So we want to capture this strength of market risk sensitivity. And that sensitivity is actually a correlation, or let's say co-movements. And we can capture any essence of co-movements from covariance. So we introduce a variable beta to let us know how much risk component that is going to lead us to ask for required returns when we do investments. Now, the only risk source that allow us to demand required return is those that cannot be diversified away. So those are the systematic risk. And we are going to catch the market risk component inside of an individual asset by beta. And what we do is we standardize the covariance between this individual asset and the market. We standardize this covariance by the total risk of the market. Now, this tells us that the co-movements between individual asset and market in relation to the market risk itself, to see how is the coefficient of this sensitivity. Now, we can also rewrite this formula into this. We just break the covariance into correlation coefficient times the individual standard deviation of individual asset and market portfolio. And then we are going to cancel out a standard deviation of portfolio M. So we can rewrite the formula into this form. Now, this beta measurement is different from the standard deviation of an individual asset because this beta here only captures the co-movements between individual asset and the market. So it only captures the sensitivity or the risk exposure to market risk, where the standard deviation of an individual asset captures the total risk of this individual asset. Now, only this measurement are likely to be a relevant risk component because we can only ask for required returns if we take on systematic risk, that's undiversifiable risk. Now, that's why this measurement is important. Now, remember this formula here, that is the formula for capital market line, where this is a portfolio because capital market line is given by combining risk-free asset with the market portfolio. So we are forming a portfolio when we do investment on capital market line. So that's why we cannot use capital market line to describe or evaluate single assets return. The capital market line can only, let's say, evaluate the portfolio's return. So we want a measurement, a reform of this equation, so we can use this equation to evaluate the single assets return. Now, let's do the first step transition here. We can replace the standard deviation of the portfolio by the standard deviation of the individual asset, which we are interested in its expected return. Now, that is the total risk measurement for this individual asset. Now, we say if an individual asset deserves any level of return, it is because it takes on the market risk. That means this risk measurement is an overstatement because it contains diversifiable individual risk. So, we want to reshape or shrink this standard deviation of individual assets. We want to capture the risk component contained by these individual assets that are market specific, and then we calculate the expected return based on that. And we can easily reshape this measurement to times it with the correlation coefficient between individual asset and market. Do so, we reshape the standard deviation or the total risk of this individual asset into the market risk component it presents. And then we insert this product, we use these two products to replace the standard deviation of the portfolio presented by the capital market line. Now, here we are looking at the new reshaped expected return for the single assets expected return. Now, does these two parts look familiar? Does that look familiar? Good eye, you caught it. It is the beta. See, it is the beta here. It is the measurement that we use the total risk of the market to standardize the covariance or the co-movements between the individual asset and the market. So, we rewrite this formula, we replace these two components with beta. And then we are looking at the capital asset pricing model. Let me refresh your memory. Let me go over this process with you once again. Now, we developed the capital asset pricing model from the equation of capital market line. We first want to reshape the standard deviation of the portfolio into the standard deviation of individual asset. However, this risk level is overstated. We need to concentrate the part where it is market-based. That's why we can ask for required return. So we reshape it into this product. And we happily arrive at a decision that these two products give us beta measurement. So we replace these two factors with beta, and we are looking at the CAMP model here. It can be used to evaluate any single risky asset on the market, and it can also be used to evaluate the required return of a portfolio. How? We calculate the portfolio beta. The portfolio beta is actually a weighted average of individual assets beta. Easy as that. Now, we see that the CAMP model offers the level of required return because it represents the least minimum of what we deserve for taking on a certain level of market risk. Now, we say it's an opportunity cost because we can get this level of return from the best alternative investments which have the similar or the same level of beta, meaning that they are representing the same level of market risk exposure. Now, if we cannot get the required return from current investment, then we are underpaid and we are missing out the returns that can be earned on the best alternative investments. And the expected return from the CAP model can be used into various estimations in terms of evaluating a stock's value. For example, we can use the dividend growth model to evaluate the value of a share, right? And the expected return or the required return given by CAP model can be used as the discount function in dividend growth model. Now, how do we apply the capital asset pricing model in a more practical sense? Well, stay tuned. I will introduce you to those interesting questions in our next class. All right, see you next time. Bye-bye.